2023 turned out to be a good year for investors. We saw globally inflation concerns abate. That led to optimism that interest rate cuts were around the corner. Consequently, share markets performed incredibly strongly, far better than we expected, and of course bond yields came down. I guess the question is, how do we see things through 2024? Our view is that returns globally will be a little bit slower than they were last year, and we'll probably see a bit more volatility, but they'll still be okay. The backdrop internationally will be one of somewhat slower economic growth than what we saw in 2023. Global growth slowing down to around 2.5% from just above 3% in 2023, but recession probably being avoided. Yes, it's a close call, but we think ultimately recession will be avoided. In the meantime, inflation will continue to head down, not in a straight line. It will be bumpy at times, but inflation will trend down as demand cools down and supply continues to improve. That in turn will enable central banks to start cutting interest rates by the middle of the year, particularly starting in Europe and the US and then flowing through to Australia. Lower interest rates in turn will help spur better economic growth as we go into the end of the year and through 2025. So I guess, what is there to be optimistic about? Well, there's a bunch of things in there to be optimistic about. We do see global growth slowing, but we think we'll probably avoid a recession. And so far, the global economy has proven to be quite resilient. Secondly, inflation has been falling. If you go back to 2022, the high point, inflation globally across major countries averaged somewhere between 8% and 11%. Right now, it's down around 3 or 4%. So it has been falling, and that gives us optimism that monetary tightening and the improvement in supply situation globally is working to bring inflation down. Thirdly, on the optimistic front, we are likely to see lower interest rates in response to that fall in inflation. And finally, there's lots of concerns out there about geopolitics, and of course I'll have to talk about them in terms of the worries, the risks. But as we saw in 2023, it's not always the case that they turn out badly. We've already seen this year an election in Taiwan, but it hasn't increased tensions with China, at least not so far. So investors, what is there to worry about? I guess for investors, there's always something to worry about. The old saying is that share markets climb a wall of worry. If we're thinking about the next year internationally, I guess there's three key worries. The first one is that inflation is sticky. It doesn't come down as quickly as we would like, and that could of course delay central banks in cutting interest rates. We think that's a relatively minor risk. A bigger risk perhaps is if the global economy goes into recession. And that's certainly a risk because we have seen a massive rise in interest rates, and that is going to have some impact. So that's certainly worth keeping an eye on. But another big one, of course, is geopolitics. Geopolitics turned out to be less threatening perhaps than feared through 2023, but there's a bunch of issues that could impact through 2024. We're seeing lots of elections around the world. Something like half the world's population faces an election in the year ahead. We've obviously got the big one in the US, a rematch potentially, or as things look like they will be at the moment, between President Biden and former President Trump. And obviously uncertainty will increase if Trump is returned to the presidency. We've also got ongoing tensions between the West and China. The war in Ukraine continues. And of course, perhaps the big one is the risk of an escalation of the conflict in the Middle East, which could threaten global oil supplies. So there's always something to worry about, it seems. But for shares, history tells us that they climb a wall of worry. And the key for investors is to try as far as possible to take a long-term approach to investing and make the most of what I call the magic of compound interest. This is where returns grow on top of returns, and it's far more powerful in growth assets like shares and property. So if you want to have good growth in your investments, generate wealth, you've got to have exposure to those two growth asset classes. But critical to that is not getting blown off by swings in the investment cycle. It will go up and down. It's inevitable. There'll be some setbacks through the course of the next year. The key is to stay the course. Critical in that is turning down the noise. We are bombarded these days with lots of information via traditional media and increasingly through social media that can create a lot of uncertainty and confusion. So the key is to turn down the noise and make the most of the magic of compound interest.